Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 17th, 2024. It's 2:35 p.m. Eastern Time as I'm starting the video. In my earlier post today, I mentioned it. I thought it was Wednesday. In my head, it was Wednesday. I'm still on island time, coming back from that vacation, island hopping in the BVI. So all day, for some reason, even though I had two appointments today, I thought it was Wednesday earlier. So we do have the Fed meeting. It is in place today. They meet on a Tuesday and a Wednesday, and then at 2 p.m. Wednesday, they announce the rate decision. So last I checked, and I didn't even check this week, we're looking like quarter points baked in the cake. And it's mostly about what the Fed says from there and the market's reaction to it. So what I'm going to do in no particular order, I'm just going to cover some updates. There were two, I saw at least in the last day or two questions put to me on updates. Actually three, I can think. This one's wheat. This was yesterday. So let me just start there and I'll kind of finish out with the markets, because the markets and kind of this whole risk on trade is everything right now. And if there's going to be a catalyst to start moving things and pop that VIX up, like it looks to me it's going to happen, a good chance I should say, then it's probably going to be the Fed. All right, so somebody asked about wheat, finding any support. So the last couple updates I gave you on wheat, we had this chart here. This is the ZW wheat futures 2-hour candle chart. I've been sharing this one lately. You've got support here. There's a previous reaction low back from late August right there, towards the end of August. That is support around 541. This is the downtrend line in the last couple updates I posted. This downtrend line needs to pop this to get wheat going. Wheat's just been doing this, setting up, putting in these 60 and 120 minute divergent lows. Again, a 120 minute chart, just every candle is 2 hours instead of the 60 minutes. I'll do that to go back a little farther in time. And so that's it. So you have a comparable setup, divergent low. You had an equal low there. So that actually, technically, the divergence just extends. You have indicators down below. The momentum indicators, PPO and RSI, are making higher highs, or I should say higher lows. That's what I meant to say, higher lows, against prices making lower or equal lows. So that's it. So we have pretty much, again, 1, 2, 3, this is support. And so that could pop and get us another run up here. But let me show you the bigger picture. And again, this was posted yesterday, so you could check it out. The question put to me, has wheat found support? So yeah, there is that price support I just showed you. Plus, you need to see, a breakout above the downtrend line to really get a rally started. However, the best support level on wheat is the long-term 25-year chart. I've shared this with you on and off over the last few months. And I would love to see that hit, especially if the big positive divergences that are currently in place are still intact. So I could expand this one, but let me just pull the live chart up for you. Correction, actually. When I say live chart, this particular one on this charting platform, stockcharts.com, is what we call an EOD, or end-of-day chart. You can see right there, meaning they update it every day. It's a continuous contract of wheat futures. This is a chart I've been monitoring this trend line for years now, a decade or more. It's a very long-term trend line. This goes back to 2000 right here. You can see that's when the dot-com bubble burst back there in 2000, and it's just a very, very well-defined uptrend line that wheat comes back and visits every so often. Back then, I had trade ideas off it back in the time back in 2016 here on the site, 2018 or at 19, and you can see, so the nature of wheat, when it comes and visits those trend lines, you get a few rallies that go, and then at least in the past, we've launched, these are parabolic uptrends. Think crypto and NVDA and things like that. Well, not so much NVIDIA. NVIDIA's not gone parabolic, but it's been a steady advance. And parabolic uptrends never end well. That's what I put back here. You have big drops that tend to follow when anything goes parabolic. You usually don't just correct normally. What goes parabolic tends to crash pretty hard. But again, so we could be looking at another one of those or not, maybe at least a run. That doesn't matter. We can't. It's been a while. Usually you don't get parabolic runs that are much closer together, at least on wheat. And I know this is 25 years. I can go back a little further than that, but that's where the trend line generates. So bottom line is you have this downtrend line. It's not super well defined, but you do have the divergence building. So you can see here on this chart, or maybe you can't see, but I have dotted blue lines right here that just show what would happen if we come down and jog to that level. We don't have to hit it, but from my experience, when a security comes close enough to a very, very significant support level, or going to the upside to a resistance level, it's almost like a magnet, like a gravitational pull. You know, when you put two magnets close together, and you can hold them in your hand, but when you get close enough, they kind of just snap together. That often is what happens. So, and it's not much downside. So I've been talking about wheat as a long-term setup, long-term trade, with the next leg up in a bull market likely coming soon. We don't have to hit that trend line, but if we do, and these divergences are still in place, which they will be if we hit it anytime soon, all the better. So, but sometimes you're looking for that perfect entry right there. We came very, very close. Maybe we pop the trend line I give you on the 120-minute chart and then never look back. So my thoughts are still not an all-in. There is support, as I showed you in the beginning of the video on the 120-minute chart. This support a little below. You really don't want to see it drop much below that. That's a very, very long-term secular bull market uptrend line, and these are all cyclical bull and bear markets within that secular trend. So that's that. All right, so I'll continue to update that. For those of you that do not trade futures, you have your ETF, WEAT. You can see it there too. Nice little wedge pattern right here. The downtrend line, so that needs to pop. That's comparable to the one I just gave you on the 120-minute chart. This is a daily chart here. And I also have it on the 60-minute chart coming off that, again, divergent low right here, equal to that previous divergent low. So boom, that should get us running. These are targets I gave you all the way back here off that divergent low. We've just... wheat's not going down, it's just not going up. It's been trading sideways. So looks to me when I zoom out this way, kind of a big, potential W bottoming pattern right there. And I really think if it can pop this former T2 level, that's where it should start to run and open the door for a bigger move up to T7. All right, enough on wheat. Somebody asked about, let me just go over to the energy stocks. I'll cover Tesla because that was the third one I saw update request. There's 3 energy ETFs that I cover regular. I watch regularly. I haven't posted much on them because it's kind of like crude oil. I've talked about that. You haven't seen a lot of posts on crude lately or trade ideas because crude's been doing the same thing. And energy, the energy stocks are going to follow crude, obviously, just like the gold miners follow the price of gold up and down. And so, we had a strong run up in all things commodity related, including energy prices and energy stocks. And, it's been a tradable, there's swing tradable trends here. You can see my chart, divergent high, divergent low, divergent high, divergent low. Right now, we did not end this time with a divergent high. All I can tell you, we're in a kind of a sloppyish range, and hence, it's been zigzagging slightly higher, getting oversold. Right now, we're actually deeply oversold. If you look at the RSI down below, this is the most oversold reading that I've seen since this one right here. And that one was followed shortly afterwards. It wasn't the initial oversold. As I often say, overbought and oversold aren't buy and sell signals. They're conditions. Sometimes it's one and done in a bull market. When you get oversold, you take off and the next uptrend resumes. But quite often you come down again, get a little less oversold, and that's what gives you positive divergence on another marginal new low. So that was a divergent low there. So we'll watch for that. Maybe you get that, maybe not. We had a recent divergent low there. I just wanted to say, and I'm probably spending more time on than I should, I don't have strong convictions. Better fish to fry elsewhere, in my opinion, because the chart's just not that clear. You got this little EKG here thing going on. You go up, down, up, down. You can see about how big the trends are. And that's it. I can't squeeze water from a rock, blood from a stone, and nor can I extract any very useful, timely information from this chart. Same thing with the other two I follow, XOP. That's the exploration and production companies. And you can see the same thing. And this is because crude is kind of slogging around sideways, and that's what these guys are doing. And this is just not a very clear chart. You can flip a coin. as to where the next 10% is going to be, in my opinion. XES came off that divergent low, same thing. So that's the third one. This is oil and gas equipment and services. All right, so there's your update on energy stocks. Feel free to bump me again. I just don't have an opinion, a worthwhile opinion to share, other than tell you they're just not tradable right now. Maybe swing trading if you can catch something that you see here, just not my kind of chart. So all right, let's segue over to the market. Somebody asked about Tesla, so I don't want to forget that. Let me just start there. Tesla will implode at some point. It has gone parabolic. This is, pretty much a parabolic ascent or near parabolic. You can draw an uptrend line right here. But really, if you start coming off this level, you can see the rate of ascent has increased. And it resembles a parabola. I don't have the parabola tool on here. Again, that won't end well. I cited some of the stats from that Barron's article today. Check it out. It's nothing new. I've been talking about some of the unusual disparity or things that stand out with poor market internals recently. It's the same story we've been hearing for years now. Fewer and fewer, just a handful, namely the Mag 8 stocks, the ones that are, yes, they are earnings behemoths, but they're very overvalued right now. Apple's earnings, revenues have been stagnant for the last few years now, but they have a tremendous amount of cash, and they have massive buyback programs, and that's just where institutionals and individuals have been putting their money. That trade will reverse at some point. I don't know when. So when you want my thoughts on Tesla, tried to take a few shots at it on the way up here before, but then it broke out of this downtrend line. Remember, I had these two primary bear market downtrend lines generated off the highs back in 2021, both of which, especially this benefit of the doubt one right there, were taken out. So once Tesla took out this trend line, it was explosive. I think every short in the stock has been blown out at this point. I think that's safe to say. In this one, you can see it's a very steep trend line. How to trade it? The question put to me was, when's it going to stop? Or maybe it was a rhetorical question. I don't know. Either way, there's a trend line. The best one I can give you right now. So it comes off this divergent low right here, back from late October. Pretty well defined with a minor trend line here. And that's what happens when a stock starts going parabolic. You basically, when you're drawing on a chart, you're going to have a series of uptrend lines like this that are getting steeper and steeper. So you have the minor trend line here. When that one breaks, it brings you to the bigger one. And at minimum, bare minimum, not if, but when the tide turns. And the tide needs to turn in the market. Remember, everything is in this day and age is about indexing. So the NASDAQ 100, you have those top, Mag 7, Mag 8, Mag 10, whatever you want to call them, stocks. Money's flowing in right now. That trade, like all trades, will reverse. When it does, you'll get more bang for your buck on shorting the NASDAQ 100, because the same thing's going to happen in reverse. All the money that's flowing into these right now, it goes the other way. So to answer the question directly, when does this stock, I can tell you the when with a high degree of confidence. When this trend line goes, if, and I have to throw in caveats, this is not black and white. This is not simple what we do. And I say this all the time. Tesla, let's just say hypothetically this trend line breaks. Is Tesla going to drop to that 360 minimum target, which would be a drop of about 16%? Again, depending if and when, I'm just assuming it broke down here. I can say with a very high degree of confidence, if I get the sell signals that I've been waiting, or the sell signal I've been waiting for on QQQ forever and a day. And that's going to bring me into the markets now. So let's do that. So a couple weeks back, about 2 weeks ago, maybe it was just before I went on vacation, I was tracking three things really: the S&P 500, NVDA, and QQQ. Normally, as you guys know, my go-to time frames for swing trading are the 60-minute and daily charts. What I had done at that time on QQQ, I had focused on a shorter term because we're so far above the primary trend line. Let me just back up here. This is the one I've been maintaining for months now that we need to break before we get any real sell signal, kind of aggressive short on the market, the trend line off the August 5th lows. That hasn't been violated, not even breached, not even intraday, no whipsaws. We just continue to bounce above it all through November right there, late October, all through November. And now this was the minor right here, the minor trend line. So I was trying to get a jump start on what would bring us down there. And so that was the sell signal I highlighted back a couple weeks ago, right there on that breakdown. It didn't go very far. We basically tested the top of this gap and then new highs there. However, and I said this at the time, that even though after that, QQQ went on to move back above there, we do still have the sell signals that I gave you the same day on SPY and the stock. To me, that's about everything. It's all about the market, NVIDIA. So the same day that QQQ broke down there, SPY gave it that sell signal. It back tested, and it's been moving exactly sideways, a very tight range. So that sell signal hasn't even become close to being negated. We haven't triggered any reasonable stop. When I say any reasonable stop, depending on your targets, reasonable stop would be based on at least a 2-to-1, if not a 3-to-1 RR ratio, risk reward ratio. So basically, we're trading right now a little bit below where we broke down after only going for the back test was a high 0.5% higher. So we still have, and this again is a more important time frame, a 60-minute chart. We still have that check mark, that sell signal on SPY. But I also said we really need to open the door and get the next sell signal. You have to take out 600 right there. And then you go down to these targets like that. So that sell signal is intact. Again, this has been a very quirky market. That's what that Barron's article I provided the link to today talked about. Very unusual. We've got the equal weighted indexes down more than they've been up this month. The S&P 500, the Dow, pretty stark numbers. And again, citing in the stats they gave, some of those market breadth anomalies, if you'll call them, go back to when they started, keeping that data back all the way back in 1999. So we're talking, quarter century of data here. What you're seeing right now is very unusual. How much longer can continue? No one can say. I've lived through the dot-com bubble. I've lived through other bubbles and crashes, and I can just tell you, there's no way to say when, but I can say when has happened, if that makes sense. In other words, I can't say when QQQ will break down, but when QQQ does break down, again, this is the primary trend line. You see it even better on the daily chart. Let me go to a clean board here. There's my clean board. So there's the when right here. There's that well-defined uptrend line off the August 5th lows in yellow. When that goes, that's going to be a powerful sell signal, which will bring us down to at least, and I believe ultimately below the 200-day moving averages. So, does it happen this week, 3 weeks from now, or 6 months from now? That part I can't tell you. But again, when it happens, if I have my other check marks that I'm looking for, which I need to see the SPY still below trend, sell signals on there, and NVIDIA. Really just those three. That's what I've been concentrating on for a while and harping on. So let's talk about NVIDIA. Like I said, this one, you broke the minor trend line here that brought us to the primary trend line, a lot like I was talking about on QQQ. We broke that minor trend line on the 15-minute chart, but then went up to a new, marginal new high, still divergent high. NVIDIA did that. Had one last check, one last hurrah off the trend line there, but a very muted, pretty relatively small bounce, and then broke down here, as I highlighted. That was a sell signal on December 10th. And then we back tested for a few days. It wasn't very impulsive. This was the rejection candle. As I say, I often like to see after a stock is back testing, because it can continue to back test for a while. And if you're short, then you're going up, you're losing money on that short, and then ultimately can even punch back above the trend line. So I like to see that rejection candle, whether it's on the first back test or 2 weeks of back testing, it doesn't matter. And that's what we got. Then I said I wanted to see this level go right here, this horizontal support level. That's gone. So all I can tell you, this is as good as a sell signal gets on NVIDIA, on one of the most important stocks, or the most important, I believe. However, it is that period between Thanksgiving and New Year's where trading volumes plummet. I'll talk on that real quick because I keep mentioning my low volume sell signals. SPY, this is the one I've shared with you many times over the years. I put a 10-period exponential moving average on the volume. That helps smooth out those irregularities, because you have the abbreviated trading days, like the Friday after Thanksgiving, markets close early, and it's also a low markets are closed on Thanksgiving Day, so you have that. Of course, that week is going to have lower volume, and the other holidays. So By doing a 10-period moving average, it gives you kind of a more flow. And you can see here, a better read, I should say. You can see here volumes have plummeted to levels unseen. Again, that 10-period EMA, the exponential moving average. I can't roll back on the daily chart. This is as far back as I can scroll. It goes back in 2019, around the beginning of 2019. So we've never seen volumes plummet this low. So it's beyond what you usually see at holiday. This is the end of 2022. It usually is this yellow line right here did the trick for corrections. We did it. We got it, hit it there. We got a correction. Actually, that big correction, remember that was we specifically intentionally shorted the NASDAQ on that drop. We made 17% or 16% shorting the NASDAQ, and I said, not SPY, because I didn't expect SPY to fall so much, and it didn't. It fell only about, I think it was 9 or 10%. So it was a here, we'll get to NASDAQ here. There's the low volume indicator on the NASDAQ right here. You can see this one on QQQ. When I say the NASDAQ, I mean the NASDAQ 100. Hit it there. We'll go back to just recent years. Hit it here. You had that nice hefty correction. Then one last marginal new high, and then the bottom fell out of the NASDAQ. Again, this is not high to low because this is a line chart. Candlestick charts show the big swoon down in the reversal when the market's bottomed in mid-October. So you don't get that on a line chart. So you can't really measure high to lows. Only these are closing values. That was still a 36% drop. So it was bigger than that. Again, if you measure the intraday highs to lows on that drop. And then that's it. In a rising market, when it's a legitimate rally, volume is normal or high, people are buying it. But these are red flags. When you drop down to my extreme level, and I highlighted it back here, and that preceded that 17% drop, we were short that not only for the low volume indicator, but that helped confirm to be short and also to ride out the big drops. I expected what I said would probably be akin to a market crash, or at least a big swoon down. Media called it a crash because we were falling pretty hard at that time. And again, those are red flags in the market. They don't guarantee a correction, and again, they're not timing indicators. So we hit it again back here, and what have we been doing? We've been going up, but that doesn't negate the signal. In fact, volume's only gotten worse. It's dropped off. So this market's going up on fumes. This market is going up largely on stock buybacks by those big mega caps that have initiated massive stock buyback programs, and by just a crowd frenzy, a mentality that they're bulletproof and doesn't matter about valuations anymore. Just keep buying NVDA and Microsoft and Amazon and Apple on a dip. But again, I'll keep talking about that for the next 5 years if this market does this. Now, if I don't have the case, these low volume indicators, big divergences, the poor market internals and other things like that, and especially breakdowns. Again, this is the setup. When you get these divergences, they're not sell signals. When you get low volume indicators, this is a level that's often caused, that first white line often triggers corrections when you get down low. But the sell signals come on breaks of support, well-defined trend lines or candlestick reversal patterns and all that. So these are the corrections, and we've got another one most likely coming up. Whether it comes after the first of the year or before, we'll see. And again, if it's going to happen soon, I can think of no better catalyst than something the Fed might say or do tomorrow. Here's my low volume indicator on the video. Let me just clean off these lines here. Let me clean everything off. So yeah, price above. Again, line chart. You can see NVIDIA volume has plummeted to, first hit my lowest purple line there, the extreme right there. And you can see the stock hasn't gone up from that point. In fact, it's gone down. It started going down, and it just tagged it again. So NVIDIA is being held up on fumes. I believe short sellers are just too henpecked and terrified to short it. But nobody's buying it, so it's not going up anymore. It's kind of like throwing a ball up in the air. You've got that rate of ascent. The velocity slows for a second there. The ball's just sitting there, suspended, not going up, not going down. And then gravity kicks in, and the ball starts to drop and accelerate on the way down. That's how, once this gets going. And again, NVIDIA is only going to go down so far because it's one of the most heavily indexed. It has a super high weighting in both the NASDAQ 100 and the S&P 500. So for it to hit my long-term targets, which I'll get to in a second, you're going to have to see the NASDAQ 100 and the rest of the Mag 8 breakdown as well. It's that simple. Not to say NVIDIA can't or won't go down. It's just not going to drop 50, 60, 70% until I get the longer-term sell signals and trend indicators roll over on the market, including but not limited to breaking below the 200-day moving averages, the 20-month period exponential moving average on the monthly time frame, and some of my other long-term indicators, which are still this time bullish. All right, so there's NVIDIA. That's what the volume's doing. The last time it did it here, we had a double tap reading right there. Low volume one was right there. The stock stalled out for a couple months right there. Had one last final gasp and hit it again right there, right at the peak. If I can do this, I didn't grab it exactly there, but you see what I'm doing. Right there, boom. Give me my arrow tool. Start from the bottom, go straight up, hit it right there. Went up for a couple more weeks, and then the stock fell again, not peak. These are daily closes, not intraday peaks, but I'm just going to measure it. It might not look like much, but that is a 64% drop. So it was closer to 70, I think, from intraday highs. And again, this is what technical analysis is about. There are no guarantees, but you study a chart, you look for past similarities in the chart, and then what happened back then when you see these extremes. And so that's it. All right, let's just go to the NASDAQ 100. Let's go to my 60-minute chart. I already covered that. So this is probably my cleanest board now. I'm going to take away, and I'll just leave it on. I was going to take away that trend line right here. That was the one on the 15-minute chart, gave us that sell signal. This is now a minor trend line right there. And it actually has a lot more reactions. See, this trend line didn't have a lot of reactions, at least not on the 60-minute chart. You had just the starting reactions, one there, and not even a reaction. It just broke down there. So really, I'm going to get rid of it there. It's not even that valid. This one has my minimum of 3 distinct reactions, and so that's the one to watch right now, I think. Set a price alert. That's how it works. And one way or another, I'll probably be punched through with the Fed tomorrow, even if it, you get one of those immediate ups and then downs. And all I can tell you is take the pre and post Fed moves, anything that happens this week, up to and even after 2 o'clock, 2:30 is a press conference, up to about 3. The market's going to move. You're going to see tomorrow after, like every Fed meeting, especially when the market's hanging on every word, an initial up or down followed by another rip or dip. The initial reaction quite often is not the lasting reaction. It can be, but there's always, you see the markets do this, and these are big swings. I don't have to tell you if you've been trading for a while and you're in something like QQQ. On a Fed day, you're going to see intraday price swings of 3%. If you're running a tight stop on your positions, especially if they're indexed positions, individual stocks, or the index ETFs, you're going to get stopped out. Even if you're right on which way the market's going. So I tend to, if I even take positions into a Fed meeting, I'll keep things light. I'll also widen stops or just pull the stops, wait till the dust settles, and then reinstate the stops if if I decide not to throw the position away. All right, so that's it. Break that. Then you get the primary trend line there in purple. Break of that will trigger a much bigger, more powerful sell signal, which would then bring in these weekly chart targets into play. My market top range was the top of that was about 512 right there, 511.74. We're 4% above that now. So on a drop that I'm calling for about 40 is T7. I'm sorry. From the top of my market top range, my final target, which I still maintain, is about a 50% drop in the NASDAQ 100. So that's relatively minor right there, that little pop above the market top range. So, and again, nothing's changed technically. As I said, if we did go above it, as long as things don't change, we still have the big divergences across all the time frames. We just need that sell signal. So we have it's kind of like a Boy Scout making a fire, get the tinder and the kindling and all that stuff in there, and you've got it all set in the fire. Well, the fire is not going to start itself until you throw a spark in there, whether you're making it with flint or you got a match to throw in or rubbing two sticks. That's the breakdown. That's so all the kindling is there, ready to spark the fire. You just have to have the sell signal, and you can see it even all the way through on my weekly chart. There's that August 5th low, that key trend line right there in white. This primary one needs to break. All right, that's the update on the markets. NVDA, like I said, is on a sell signal. You can take it with a grain of salt if you want to. And again, this is my weekly chart right here. So this is the chart. This is the one where I give you the long-term targets. T4 is still my final target, calling for a 72% drop in NVIDIA. I laid that target out on June 26th, right here. Right in here, somewhere in this. So we're exactly where we were back then. We went ever so slightly higher. Relatively speaking, remember things are all relative. Ever so slightly, 10% move on a stock, you're calling for a 70% drop is not much. We're right back to where we were when I laid these targets out. Still maintain them. The only difference now is we're below that primary trend line. That's where you can see it right there clearly. We took it out last week, and this week you don't have to squint to see it anymore. We're clearly below it. So maybe it plays out, maybe it doesn't. And then when I look at this board here, remember I have this support zone. Was cap the highs here, cap that high. There was a breakout right there. There's the first week we made. Oh, there was your breakout candle. We followed through. We back tested it. Very, very important level. It's kind of should put the nail in the coffin if and when we print a solid weekly close below. This candle's still forming. We have a couple days left. Today's only Tuesday. If by Friday this candle's down here, that's going to be a pretty good check mark for both NVIDIA and the stock market, in my opinion, and at which point I would definitely add to my NVIDIA short. It's one of the few Mag 7 stocks that have individual short. I'm waiting to add for a reason to short Tesla and Netflix right now. Netflix and Tesla and NVIDIA, those are some of my favorites of the Mag 7. Or you can just keep it simple and short QQQ or buy SQQQ or short the NQ futures. Netflix is below trend, but we need this. We need the NASDAQ 100 to break down, and then you'll see all these other high flyers follow. And I'm going to put a line here for you right there on Netflix. This is a daily chart. You had this all-time high here, got rejected off there, pulled back, finally broke out there, back test. So that's the one. Once that goes, because we're already below trend. We broke down, but again, we've been going sideways. Nothing impulsive. That's because the stock, the NASDAQ, I should say, not the stock market. Very, very clear. The stock market hasn't been going up as evidenced by the equal weighted indexes and the Dow and everything else there. But the NASDAQ, particularly those Mag 8 stocks have been going up. So that's it. I'm going to set an alert right there for you. Here's the Dow, DIA. This is nothing but red sticks. This is a daily chart. I don't really chart or trade the Dow. It's not very diversified, but it's still relevant in the sense that's what they talk about when you turn on the NBC Nightly News. They're going to talk about the Dow, what the Dow did. Dow. They're just 30 stocks. But, I mean, look at that. And then NASDAQ is going. That's a broken market, guys. I'm sorry. There's just something wrong under the hood. RSP, equal weighted S&P 500. Red sticks, broken down below its primary trend line off the August 5th lows. QQQE, not there yet, waiting for that to break down. And, of course, QQQ itself. A couple more things. Let's do an update on natural gas. Natural gas long-term chart. This is my weekly chart. Goes all the way back to 2005. Shared it many times with you in the past. Nothing has changed in recent months. I look for these divergent lows, such as this one, divergent low, divergent low, divergent low, divergent low, divergent low. You can see they come at fairly regular intervals too. And then you get these triple-digit rallies, 222%, 160, 234, 208, 563, and so far only 142. That doesn't fit. So that's why I still maintain a price target of $5, which I've been maintaining for a while now. This is long term. If you're trading short term, I'll give you updates on the 60-minute charts, which we'll do right now. This is it. So we've been, since this low right here, we've been stair-stepping higher. And uptrend is defined as a security making higher lows, which I just circled, and higher highs. Although we're still in this range, we really need to pop this three. This is where when we pop if and when we pop 366 right there, then it should be, in my opinion, spark up an impulsive rally that'll probably take us to $5 in relatively short order. All I can tell you right now, we're coming off the most recent divergent low. You get these divergent highs, time to correct. Divergent low rally, divergent low rally, divergent high correction, divergent low rally, divergent high correction, and the most recent divergent low on the 60-minute chart. So if we can power on up there and then pop through 366, it should be smooth sailing. If I go out a little farther, you can see it right here. This is the level. That's why I think that gas will run. That's a very, very big and significant resistance level that should spark a nice rally when we take it out, if and when. And for those of you that do not trade futures, fret not. We have UNG. Does a pretty good job tracking, not a perfect job. No ETF or ETN will. Futures are more your pure play, but again, if you don't trade futures, this is your option here. And you can see we're still in this trading range. We'll still highlight these divergent lows. I'll highlight these divergent highs, swing it, and I think once we break out of there, we had that one breakout that ended with a big bearish rising wedge divergent high. We hit my 5th target zone. Again, it's kind of a long-term trade with shorter-term swing trade updates in between. However you want to trade it, I still maintain these targets. But as I always say, best to align the targets on UNG with those on natural gas. What I mean by that, if we're ripping and rocking, we get up here and we're going up here like this, and you're eyeing 2166, but NG, natural gas futures, right here hits $5, I would book, close, and probably reverse to a short if the charts confirm at the time. So again, over time, this chart will have decay, for lack of a better word, and you'll see that over time, and an ETN that's has ETN or ETF, always was an ETN. I don't know why they're calling it ETF on this charting platform unless they changed it. But over time, just like holding the VIX tracking instruments, you're going to lose money, even though natural gas has not gone down since 2008 by 99.84%. So this is more of a hit and run instrument here, especially using the ETNs than the futures. Futures are going to roll anyways into different contracts as the monthlies expire. All right, let me wrap up. I just want to wrap up by looking at Treasury bonds. And TNX, the 10-year bond, is the most important to the stock market and the economy. And so this was, as I've highlighted here, that was when the Fed started cutting rates. We started a first rate cutting cycle in years, started on September 8th with a 50 basis point rate cut. Most, not all, including us, we were long, or I'm sorry, we were short treasuries. Most of the world thought that treasury bonds and mortgage rates or all that were going to drop, and the exact opposite, and a hard opposite, not just this is the Fed losing control. So they cut rates there, and a monster 50 basis point cut. So instead of treasuries going down, the yields on treasury bonds, they went the other direction. Then they did another 25 basis point there. Yields went up again, had a little abatement. We were expecting that. That was right before I went on vacation. We threw out there, the RR for being long treasuries was favorable as both a pure play and as an indirect hedge to short. So rates fell, bonds went up. I came back from vacation right there, said time to close them out. The RR is no longer favorable, and we reversed. And so that's where we're at. Well, more importantly, that's why I want to cover it right here. We're back to that trend line, which I suspect, I can't lay a hard bet. My degree of confidence isn't too high, but I suspect whether or not we get this after the Fed tomorrow, or not. Ultimately, I think this trend line gets taken out, and you know my thoughts. This is where the market will start to be very concerned when that recent high in yields and the 10-year is taken out, and they will start to freak out when that one gets. If we get anywhere near that peak, that's when the stock market, that's when Treasury yields peaked right there. All hell will be breaking loose in the market once we take out those levels. And I think it's quite possible for all the reasons I've stated, including but not limited to the fact Treasury bonds, by every metric that I know of in technical analysis, ended a secular bear market, meaning falling yields, which is bullish for stocks, that ended with the explosive overreaction from all the central banks when COVID hit right there. And you've taken out both the primary downtrend line, which is very significant, and all the previous reaction high. We've taken out all the previous reaction highs. In fact, Treasury's spiked up to yields not seen since back in the late 90s. And so hard to say whether we do this first or we just go up from here. But I do believe in the coming years we're looking at higher Treasury yields, which are constrictive to economic growth and ultimately will impact the stock market. And if you don't believe me, just pull up any book on the financial markets. It's just 101, textbook 101. Lower rates spur economic growth. And not only that, because the cost of capital is lower, it forces money out of safe haven Treasury bonds. Back in the day, this is what pension funds were chock full of, Treasury bonds, because they could lock in 7, 8, 9, 10, 12%. And they knew exactly they had certain liabilities they had to meet, meaning future pensioners taking money out, and it was very easy to do so. The Fed, even by their own admission, back in when the financial crisis hit, Bernanke said it on record, he knew by bringing rates down to zero, it would force people out of safe haven Treasury bonds into equities. So there's that double whammy effect you get. That's why you're looking at one of the strongest bull markets in history, because we had the biggest bear market in interest rates, which is, again, bull market in bonds, bond prices going up. But that seems to have changed. And so, again, this is long-term stuff, guys. But it is long-term stuff, what I'm talking when I look at this monthly chart. But near-term, I'm giving you what I believe to be valuable, very valuable levels. Watch the 10-year yield. Pops that trend line. You've got that reaction high. The trend line may not do the trick right away, but you have that previous reaction high there. So, or the easier way, I did this for you earlier in the year, color code and everything for you. Just write boxes here. Green zone, where the market's okay with it, net bullish for the stock market. Yellow zone, the stock market starts to take note of rising yields, which it has. I just showed you in the video. If you thought QQQ was a stock market, well, number one, you're wrong. It's one of the least diversified, what's still considered a broad-based index, but it's not broad-based. It's all mostly tech stocks, 50% tech stocks, no financials. It's not a diversified. It's basically a tech fund. It's an index, but it's just all the big Mag 7, Mag 8 big tech stocks. So what I just showed you a minute ago, the Dow is nosediving, the S&P 500, especially the equal-weighted nosediving. So this, once again, is correct, just like it did back here. We're in the yellow zone. The stock market's taking note. I'm sorry, all my notes are kind of squished over here. And so if we enter the orange zone, it's going to be a break. Remember, I just showed you the recent peak in the 10-year yield. This is IEF that tracks the 10-year bonds. So these are prices. So if we take out this recent low on IEF, or you can look at ZN, the 10-year Treasury, then you're in the orange zone, and the stock market, I believe, will really start to take note of rising yields as it did back there. Red zone, the market's going to freak out, in my opinion. That means you're going to get back to where rates were. Nobody, again, with some exceptions, myself included, and I'm sure some others listening to my voice, believed that the Fed would embark on one of the most aggressive rate-cutting campaigns in history, and that this could possibly happen. As I showed you, they started cutting back here, and instead of rates falling and bond prices doing this, they've done the opposite so far. So clearly, you can say what you want, but you cannot argue the Fed has lost control of the long end of the curve. That is not a subjective opinion. That's fact. Now, does it continue? That's the million-dollar question. If it continues, and we may not know immediately after the FOMC decision tomorrow. Again, this is something to watch for going forward, potential developments. Likewise, if the long end of the yield curve does start to come down and bonds rally, and that could be the catalyst for another nice 2025. Maybe we get a big blow off top in the stock market, or we see the market continue to rally. We see the poor internals start to clear up, meaning more broad-based participation. The sectors and the stocks have been lagging. That is a possibility. So all I can tell you is what to look for, and even the hard levels that get kind of more precise. So if you want to trade bonds, or you want to only trade the stock market, but you want to use bonds as your cue, well, that's it. Watch the 10-year. If it breaks below the recent lows in price, which is the recent high in yields, that would be, in my opinion, time to maybe increase a long-term position on a short on equities. And again, each of these, it starts to it should really impact the stock market. I'm going to say shocked, not surprised, if the 10-year got anywhere close to that previous multi-year high right there, and the stock market was still doing hunky-dory. All right, I'm going to wrap it up here. Let's wait and see what happens tomorrow. And I usually don't comment right away on the initial reaction to a Fed announcement unless I see some big technical developments. And the biggest one for me would see getting NVDA a little bit lower below the horizontal support it's on, and then QQQ to break that primary uptrend line. I just want to quantify it for both you and myself right now. We'd have to drop from where we're at now just to get to the trend line by tomorrow. It's going to be about a 3% drop. That's not much for the NASDAQ. You could do that in a blink of an eye. But then it has to go down below. It has to drop beyond 3%. That would, again, take us to test the trend line. And the MO so far has been buy pullbacks to that trend line. But it's getting very long in the tooth, and the divergences continue to build. And therefore, we could shoot down right through it. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.